Check, 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 1, 2, audio check, looks good. Discord audio looks good. YouTube audio looks okay. Video looks good. And I think we're live. Okay, good morning. It is Friday, January 12th, 2024. This is another coding stream, but we have very small attendance here, and that might be because there is so much snow out on the ground. This is the current view. I just took this picture a couple of minutes ago. This is the current view outside of my office window, and we're expected to get another 12 inches today. It is snowing right now, and we're supposed to get another dump here today. So that's fun. We got a couple of questions queued up here. Some of them are related to coding, and then some of them are more trading oriented. And actually, I wanted to touch on this one first because this one really got me thinking last night, and I think it starts a better and more interesting conversation. Neo asks, could you talk about your experience on mean reversion strategies? What have you used, seen that was effective? Whether it was indicators, price action, something else, and what about the risk management on it? Any tips you can throw in on that? So he and I were talking about this earlier a couple of days ago, and essentially when you're doing mean reversion, when you're building a mean reversion system, what does that actually mean? That you're building a mean reversion system. It means that you have anticipated some kind of price movement that is going outside of the bounds of, let's call it normal or expected. Let's say this is where you expect price to be, but price has gone outside of it, and you expect price to revert back into this mean. So in this drawing here, you would expect to get long. Down here, expecting that the price would return back up into the mean. This is fine. A lot of opportunity can be generated with a mean reversion system. For me, I think the number one thing that I see either with my clients or others who I speak with, and just over the years, decades that I've seen, is folks using the mean reversion system really need to have their risk in check. What does that mean? Where does this stop? Where are you crying uncle? Where are you throwing out of your position? Mean reversion can work really well. You can do things like double up on your position as it moves further away from you. That's one thing people do. Or add small pieces here and scale into it so that their position is weighted as low as possible for something like this, so that when it pops back up, they can be in a good spot. All that is great as long as it works, which, let's just give it a number. This is arbitrary. Let's say it works 9 out of 10 times. This type of thing in the right market environments, in the right context. And let's say that this does, after you put an entry on here, let's say this does go ahead and make its way back up here, and then you can get out of the position here. So let's say that happens 9 out of 10 times, right? I think that's being very generous. The blind spot that I see a lot of folks who are trying to build out mean reversion automated trading systems, or even discretionary, is what do you do that 1 out of 10 time, or whatever the percentage is, when it just doesn't come back and it just keeps going against you? And then almost all the time there's no plan for that. So what if this scenario A does not happen, but instead scenario B happens and we keep going down like this? There's so little, how do I phrase this? I am shocked by how many folks I talk to who are looking to implement mean reversion strategies who have not thought this through. What do they do in the situation that it actually keeps going against you? sure, if you bought some here, got a small position on, okay, you bought some here, now let's say this is 1 standard deviation away and you're looking for a revert to mean, now it's 2 standard deviations away, now it's 3 standard deviations away, and you're just loading up, loading up, loading up. 1 second. And it just keeps going against you. Now, if you're discretionary, what I see a lot of people doing is just not being able to swallow the loss, and they don't have a fixed stop in place because of the nature of their strategy, and it worked the previous 9 times. It just kept going back up. But now this 10th time, it's not going back up, and they don't have a fixed stop in place to stop them out. So that's one issue. That this can cause blowups. I mean, this is how you end your account in your trading journey. Is doing stuff like this, not respecting the risk. Another thing that they do is that there's no plan for how many ads and what size ads you have and where that stops. Like if it continues to go and you add it at standard deviation 1, 2, 3, what about standard deviation 4? Are you going to add down there too? Or are you going to cut the position and cut your losses and try again? So I guess you could summarize what I'm saying is the number one issue that I see folks trying to implement mean reversion systems is that there is no adequate plan for respecting risk in the event that it does not work out the way that you think it would. Mean reversion can work really well in certain market environments. This is a great strategy for when we are stuck in some kind of choppy range, regardless of the time frame that, let's say the market, whatever market you follow, is moving sideways. Well, hindsight being as clear as it is and as wonderful it is, you could short there and you could buy there and you could short there and you could buy there. Looking back at a chart, that's super easy. And again, during those choppy type of markets, that will revert back down to the mean, to this middle section here. It will revert back down there, and you can collect that. You can collect that. You can collect that. You can collect that. That's all fine and dandy. What are you doing about the outlier case? Because that outlier case is going to end your account. And what are you going to do if it does continue going back down? What are your actual spots to add? What are those based off of? What are the criteria that those are based off of? Where is your pain point? Where are you crying uncle? Where are you getting out of the entire position? And how are you holding yourself to that? Is that a physical stop you have in place? Have you actually entered an order? So if you're trying to, let's say, get long right here, and you don't know that this is on this side is going to happen. Let's say you're getting long, expecting a reversion back to this mean, right? Where do you have a physical stop in place down here? Where is it? How is it getting put in? Is it discretionarily getting put in your semi-automated system, or is it getting put in by the system itself? How is that measured? What is your plan for if you get wicked out? Are you going to try to re-enter? Does that make sense on a mean reversion system? So if you're looking at mean reversion systems for discretionary or automated trading, respecting of risk, that's probably the biggest thing that I see people missing out on. How to respect the risk. Are they respecting the risk? Is it an actual respect of risk, or is it just, I'll stop myself out by hand if it just keeps going against me? Well, that doesn't mean anything. That means nothing. That's not tangible. That's just something up in the middle of the air that while you're in high emotions as it's running against you, like in this scenario here, you are not going to actually think logically, reasonably, and put some kind of account protection in place. And what you're really risking when you do this, I mean, let's be honest with ourselves, you're risking blowing your account. There's several folks on YouTube who I've seen had trading channels where they traded mean reversion systems, and while their wins might be consistent and small, and the win percentage might be 90%, 80%, 70%, just stupid high win percentages, right? These are excellent win percentages that just are coveted by everyone, right? You want to be right all the time. You never want to be wrong. That's not realistic in trading, but that's a separate conversation. But you can go along and chug along doing this in a certain type of market regime for weeks, days, weeks, months. But then that one time where the market actually goes against you, you blow your account because you just keep expecting it to revert to the mean. It never does, and then it's game over. Then you're done. Then you're done. Then you don't have a chance to trade anymore. Look, we all come into this business with dreams and aspirations of becoming financially independent and all that. Everybody's got their reasons for going into trading. Some people just want to make money. Some people want the ego satisfaction. Some people want to be able to accomplish some other goal with the money that it comes in, whatever it is, whatever the reasons for you being involved. If you blow your account, you're out of the game and you're done. So using that logic, just being a reasonable person, what's the most important thing in trading? The most important thing in trading is not blowing your account so that you can trade again tomorrow. So if you are using a system like this, but you don't have a plan for the 1 out of 10 time or whatever the percentage is, I'm sorry, but there's a very high chance you will blow your account and you'll be out of the trading game in the long run. Okay, I'm kind of rambling on this, but I think this is an important discussion. Now, I guess the flip side of that is, well, how could you implement some kind of mean reversion system, let's say automated or discretionary, that does respect risk? Well, the first stop is knowing where your out is regardless of how many ads you have. Do you have a specific out? Is it like marked somewhere? Is it calculated somehow? Is it every single time? Not once in a while, but every single time. Do you have, I call this, pardon the language, I call it an oh shit stop. Like what if you're doing mean reversion and then some news hits that some conflict started and just everything goes? Do you have an oh shit stop in place? I don't know if people remember, but there was a flash crash back in, what was it, 2015? Somebody can type and remind me. Where the market just dropped out quite a few percent. I don't remember what the percentage was, but it was, I think, double-digit percents within just a few minutes. If you didn't have oh shit stops in place, you are blowing your account. You can't just expect life to be the 90% of times when everything works out nice. You have to protect yourself in life and in trading. You have to have this in place if you don't want to blow your account. So that's one thing. Where is your final out where you're giving up on this trade idea and this trade attempt, and you are saying, okay, I was wrong, and I'm going to move on? That needs to be, in my opinion, that needs to be in place all the time. The second piece is having a system, a very specific, explicit, detailed, written out in whatever format you want of where you're adding and how much you're going to add at which spot. So if these are standard deviation levels, let's say 1, 2, and 3, how much are you going to put on standard deviation 1? How much are you going to put on standard deviation 2? How much are you going to put on standard deviation 3? Why are you putting those on? Do they have separate stops, or are they all going to respect the one oh shit stop that you have? All these questions need to be observed. So yeah, risk. Really, it's about risk management, because it's not fun to blow your account and not be able to have an opportunity again. And it's really hard to build up the funds to have another account. So I highly recommend not blowing it. In terms of mean reversion strategies, I don't play a lot of them. I like to stick to the trend following strategies for the most part. So you won't see me doing a lot of mean reversion strategies. If the market is very choppy and we have very low range, I might start to look to pick fades of tops and bottoms, but I will have a very specific out, and I won't be adding to the position. I'll try to pick a bottom and pick a top in those types of markets, but I typically don't trade that. I typically trade trend following, where I have Actually, this is a great topic to segue into because I wanted to talk about this. What is your, and we're going to just get way off topic here. What is your edge? What are you leaning on, and how is the table tilted in your favor? Really important questions, in my opinion. This is a broader topic. I really want to touch on this first one. What is your edge? Trying to think of how to formulate this statement in this question. This really should be a discussion, a group discussion, but there's a small group here today, so there's hardly anybody in here to have this discussion. But having an indicator on your chart where you buy if the indicator gets above a certain value and sell if it gets below a certain value or something like that, that is not edge. That is not something you're leaning on, and that is not tilting the table in your favor. That's what I would argue. That is you looking at an indicator's values likely lagged over time and trying to pretend that if you saw it happen in the past and you're looking at it back in hindsight and all the lines are pretty and lining up and everything looks straightforward, you think that you'll be able to do that real time on the hard right edge. Sorry to bust your bubble, but that's not the table tilted in your favor. You will probably, I mean, go ahead and try it. If you get fantastic results, then continue to do it long term. But my guess is that anybody who's listening, anybody who has tried this type of thing, knows that that does not actually tilt the table in your favor. You're not exercising an edge of any sort there. The reason that I look for trend joining or trend following types of trades to participate in rather than the mean reversion is that it's part of what I can lean on. If you watched any of the live trading videos that I put out on the channel, I'm looking for a thrust. Let's just assume long side. I'm looking for a big thrust in one direction. Let's say it's up, and then I'm watching where the volume occurred on that up thrust very carefully, and if I see what I think is institutional involvement, institutional volume, institutional order flow on that move up, then I will try to find a spot on a pullback that I can lean against. It's a spot that has significant volume that I have identified as potentially being institutional order flow. In other words, they have firepower, they have money to buy more, and if price returns back down there, let's say this is where a huge order went off at this price level, right? And if it gets back down there, as AMD hits lows on my other screen, if it gets back down here to this level, that institution is likely wanting to continue to buy more at that better price. Rather than buy it up here, they'd rather buy it down there. That's another thing I'm leaning on. And because I can see where that volume happened, and I can interpret that as institutional volume, not retail volume, that tilts the table in my favor. So when I'm putting my buy order, let's say right here, right below where that institution just bought a bunch, my edge is that if we get back down here, it is highly likely that that institution will want to pick up more shares in this company at that good price rather than up here. Since they're buying it, they're clearly buying it. I can see the volume coming through. It's pushing up higher, higher, higher. I can see what looks like to me as institutional order flow. And then all of a sudden it returns back to the price that they wanted to buy a bunch at. That's the table tilted in my favor. I would rather risk right there where they're about to where they did all this volume and where they committed. I'd rather be entering my position right there and tilt that table and lean on that institutional order flow. And the expectation that the institution would be buying more at that better price rather than up here, that is an edge. Do you see the difference, everybody who's listening? Do you see the difference between looking at a value on something that's going like this, an indicator, and saying, okay, I'm going to buy that? Well, what does that mean? What does that mean? Is this guaranteed to come up here? No. This isn't guaranteed to come up here either. But at least here I know that an institution was participating here, and if I'm wrong right away. I can set my risk right there. I know I'm wrong if they don't continue buying it. So can you see the difference between these two? Here you have nothing to lean on if you're trying to trade off of this indicator value being here. Here I'm leaning on quite a few different things. And on top of that, context, day structure, it's not as simple as just this, but there's a lot of other things involved. But when you put all the pieces together, I have tilted that table in my favor. So when I do participate, which as a retail trader, that's one thing you can control, is when you participate. So when I choose to participate, I'm in a position of strength usually right from the get-go. Okay. What can we go to now? I guess, does anybody have questions on this stuff? You can write into the coding stream chat for those who are here. It's a good question, Neo. I like that. Now, I also should say that doesn't mean you can't make a mean reversion system work very well. You absolutely can. I'm just saying you need to respect the risk and have the risk piece worked out. If you have the risk piece worked out and you have something to lean on, the edge to lean on, then absolutely. Mean reversion can be a really consistent, great backdrop for how to set up your trades or your strategy or approach. Okay, let's start up here with true. Okay, I'm wondering what's wrong in the code. I came across a post on Twitter. It outlines a ridiculously simple trend following strategy based on VWAP that has good results. I wouldn't put my money blindly on this, but thought I'd try to code it up. It stays open in a position as long as it's on the correct side of VWAP and exits if the candle closes the opposite side. The problem is I'm terrible at coding. I Frankenstein some other things together, and chat GPT, but I'm not doing something right when I test it. It seems to enter positions, but it won't exit positions. I must be doing something wrong. I'm stuck at this point and I can't figure it out. True, are you around? I do not see you in here. Well, let's take a look at the code that True posted, and let me download that. Open it up. It opened up in Notepad. I want it in Word, or in Vim, I should say. Let's do this, edit with Vim. Let me change it to a C++ file. I'll call it true.c++. Yes, I want to change the type and edit with Vim. At least that way we get some syntax highlighting. So here we go. Hopefully everybody can see that. Never looked at this before. So moving average, auto DLL. We've got some inputs up here. We've got those inputs being initialized here. We've got fetching those inputs. We've got a moving average study, which is probably the VWAP that True mentioned. We are getting the data from that moving average study right here. And we're also getting trade position idea. He has a comment here that says for exit processing. Here's the last trade price. Looks like there is a persistent integer getting stored. I'm not sure what the purpose of this is yet. Here's creating a new order. It's going to be a market order for this order quantity. And this is a Boolean that's checking a couple of different things. that will probably later on determine if a trade is allowed to happen. By the way, guys, on something like this, this is really hard to read. Just as a human being, I find this type of thing difficult to read. So what I like to do in situations like this, if you have a Boolean that you need to build called trading allowed, I like to build it up into its separate components. So you see over here, they've got this ampersand, so there's a second piece to the conditional. Let's go ahead and bring that to a separate line, just so that's a little bit easier to see. So there's two conditions being looked at for this Boolean to get set. The first one is whether or not bar time is greater than whatever the entry time is. So that's number one. And the second one is bar time less than whatever the exit time is. So I'm assuming entry and exit time are specified up somewhere up here in the input. So this is probably like eligible trade start time, eligible trade end time. So like when you can enter, when you no longer can enter positions is what I'm guessing that this is. Trading logic. Let's read through this comment together. Enter long if the current 1 minute candle opens above the moving average after the first minute. Set the stop loss at the current price level where a 1 minute candle closes below the moving average. Enter a short. So this is the flip side then. Let's just worry about the long side for now. So if trading is allowed, which we set up here, if it's during eligible times, so you can really consider this variable trading allowed as eligible trading times, and we're not on the very first index. In other words, we're not reloading the chart. And actually, this I would not put like this, because what you're saying with SC index is greater than 0 is that, let me go ahead and pull up why you don't want to do SC index is greater than 0 is because if this is your timeline and this is 0 and this is SC dot array size minus 1, let me change this to a slightly smaller and there. If this is bar index 0 on your chart and this is the most recent one, well, you wouldn't really want to execute that trade on bar index 1, would you? No. So I would consider updating this, and SC index is greater than 0. I would consider updating that to be an SC index is equal to array size minus 1, so that you know that you are not only not at the beginning because of a refresh or a recalculation on the chart, but that you're actually sitting on the very most recent bar on the chart. You're sitting live, if you will. So another thing you could do is you could tuck this piece of the conditional back up into trading allowed. You know, why not? Let's take a look here. You could say and sc.index is equal to sc.array size minus 1. And then you can remove this here. And then what you have is if trading is allowed, which has the gate, that way the conditional for the index being not at the beginning, but rather at the end, like a live trade. We have the bar time, so our eligible start and end times, and it's all wrapped into this one little Boolean here. But now you can read it a little bit easier. You would need a semicolon at the end of this as well. Anyway, so there's the long side here. So if the open is greater than the moving average, so the moving average is the VWAP. So if the open is greater than the moving average, let's take a look at that. So if the open of the candle, let's say this is the open of the candle right there, and let's draw a moving average. Let's make it a different color. Let's say the moving average, I don't know, let's say it's like this. And things are moving down, but then this one opened up. If this is here, then it wants to go long. Okay, so let's go back to our code. So, actually, there's something else I see here. Let me take a screenshot of this and bring it back in there to the Excalibur so we can draw around it. So there's a problem with this statement here as well. Oops, that is not what I was trying to do. There's a problem with this statement here as well, because right here, And right here, true, you are accessing the 0th bar index for open and moving average, so VWAP prices. So you know what data you're actually looking at is this of the moving average and whatever the price is at that 0 element. You're accessing this 0 is this 0 bar index. So you're looking at this data that's right here. So even though you're trying to make a trade decision off of this area, you're actually looking at the data from here. So what should this be instead of 0? Well, this should be instead sc.index, so that you're operating on the most recent bar, right? You're not trying to look at whether the very, very, very first bar on the chart, which could be days, weeks, hours, whatever ago, you're not trying to look at that piece of data. You're trying to look at the most recent piece of data. Exit conditions. Oh, so before we finish with that, so if that happens, then buy a new order and then set the index to the trade index, which, remember this variable up here, it was being stored in a persistent integer memory space. And so that would go ahead and set the index that the trade entry happened in. Now, I think the problem that True said was that this is not exiting. This is not exiting, which means that either this is not getting evaluated to true, or this is not getting evaluated to true. Or new order for this buy exit, which is the sale of the long, the closing of the long, this new order, where is this being created? It's created up here with a quantity, with a type, with a time in force, but what does it not have? It does not have a side. So this order will get rejected. And what you need to do in order to see those rejections is go to the trade menu. I think it's the trade service log. So it's this one. Trade service log, I think, is what you need. It's under the trade menu. It's like, okay, let me just show you here. It's trade service log. This right here. This guy. You need to open this up and see what the error is for the order that you tried to submit via ACSIL through C++. It'll show you here invalid order, no side. It'll say something like that, no side found, or something similar to that. So you need to go and find that error, but I can see right away that since you're not providing a side to the order on here, or maybe it's assumed because it's a buy exit, so maybe it assumes that it's a. I have to go check the docs. Maybe you're right. Maybe it doesn't need a side. But I think that one of the things that might be happening is that you're having an order error. So check that trade service log. The other thing, of course, is these indices, these bar indices provided here, also need to be updated to be using SC index rather than using 0, because you're still, again, referencing the very first bar's worth of data on the chart rather than whatever the most recent bar is. But True, I will ask you jump on the stream next time so we can talk it through, just because it's hard to get clarifications on questions as I'm looking through. But hopefully that'll help resolve a couple things. Reversion has a question here. Oh, actually, no, this is a follow-up. All places where you got this kind of thing indicates the buyer. Oh, so this is what yes, thank you. Reversion, exactly. Exactly. Reversion caught it and pasted it. I just didn't have time to read. Perfect. Neo, we already covered that. Okay, J-Glass. The question is about divergence. A divergence is when you have two pivot points, current pivot and previous pivot, Respectively, you have a price and indicator in an upward trend on the 1 minute. If the price makes a higher high, but the indicator makes a lower low compared, how can this be detected? Let's say we define pivots as fractals. We could use RSI for the indicator for reference. A more specific question would be, what is the best way to hold values of a previous pivot point and compare that to the current pivot? So there's quite a few different questions here. The first, let's go this way since that way is full of drawings. This section is asking how to code up pivot or a divergence detection. And then the second one is how to save values in memory to be evaluated on or later on. This one is actually visible in that code that we just covered a moment ago, where true had been assigning a get persistent integer. So that's one way to save using the persistent functionality of ACSIL that allows you to save various values to persistent memory so that on the next run of your script you can recall it, or later on when you're running your script you can recall it and compare those values. So there's a couple different ways to do this. It kind of depends on the data type. So if you are trying to save a number, you're going to want, that's going to be an integer, so you're going to want to use something like get persistent integer function. If it's a decimal, it's going to be a type float, and there's Microsoft on highs apparently. And you're going to want to use get persistent float for saving those to persistent memory. Likewise, if it's a string, it's going to be an SC string, and you're going to want to use get persistent. I don't remember if it's persistent SC string or get persistent string. I don't remember which one it is, but it's one of those two. So the way that you would save those, what is it, RSI you said? So RSI is going to be probably decimals, because it can be in between integer values. The value of the RSI can be in between integer values. So if you had calculated at the beginning of the chart or wherever you have calculated a value of the RSI and you need to save it, one option could be to explicitly set a float variable that you end up storing in get persistent float and then updating it and using it for comparison later on. In terms of coding up divergence detection, I think that's a good topic for separate. That's like a lengthy thing that we're going to run through. That's going to take more than half an hour probably to code up. There's quite a few different ways to approach this. In general, what if I did a high-level overview? So you have something going up, and then you have something else going down, and then what color do I want to use for? You have to find a point that you want to identify as diverging, and what does that mean? Well, it means you need to determine what your sample size is. So if your goal if the goal output is there divergence, right? That's essentially what? A yes, no? So it's essentially a 1 or a 0 output that we're looking for in the end. Is there divergence, yes or no? But there's actually a third attribute to this in the sense of time, or bar index at least. Is there divergence at a specific point in time or at a specific bar index? So that's kind of how I see that. So if you wanted to determine divergence between these two, you'd have to determine a sampling rate. Are you going to sample once every second? Are you going to sample once every tick? Are you going to sample once every bar? What's the bar period? Is it a variable bar period, or is it a consistent bar or a fixed bar period, like a 5-minute chart? Or is it a volume-based or range-based, which could be a different time time durations. But if you have a sampling interval specified, you know how frequently you're going to be checking both indicator values for potential divergence. But let's say this is T1, which I'm going to use as time 1, and I'm going to encapsulate this here. And then I'm going to go like this and set T2. And then we're going to take this value here at T2 and this value here at T2. So here I'm sampling only two data times, right? I'm not sampling more than 2. I'm sampling time 1 and time 2 on both of the indicators, on both of the studies here. So I have data for T1 for the RSI and for price, and then I have data for RSI and price at time 2. And now the question is let's say this top line is price, and let's say this bottom one is RSI, okay? The question is what is the slope? What is the rate of change between time 2 and time 1 for this indicator? Well, visually we can see the value of the price at time 2 is higher than the value of T1. Well, how would you calculate that? Well, this spot right here has a coordinate value. It has a time, it has a price. I'll do it like this: time, a price, and oh, that's it. It has time and price. Likewise for this. This has a time and a price. This also has a time and a price. This also has a time and a price. So if you took this price and subtracted it from, and took this price and you subtracted this from this, you'd get the net difference of where T2 is relative to T1. Likewise, if you do the same thing for the RSI, so this would be a negative value, the difference here, because this is going down, so this is going to be a negative value, and this is going to be a positive value. So because you know that this is a negative and this is a positive, is there divergence? Yes. If they were both positive values, let's say this did not happen like this. Let's say this happened like this. Then what's the difference between here and here? It's positive, right? They're both positive. They're both going up. So is there divergence if they're both positive? No. So that's the basics of how I would build out a divergence detector. Is figure out what your sampling rate is, start finding the slopes based on the sampling rate that you are looking to achieve, and then do that calculation of whether or not they're going in the same direction. That's the very, very, very basic 5-10 minute version of how to detect that. And that's what I would use to save it to memories for later comparison based on whatever the sampling interval that you have is. Good questions. Ziggy has a question here. How do you approach a study or method to quickly cycle order routing for IBKR symbols traded within Sierra? What are the IBKR symbols? What do they look like? I don't use interactive brokers. Ziggy, you're on here. Do you have a mic? Are you still awake? Ziggy's typing out a response here. Can't speak, but I can post an example of a symbol. Okay. What does a symbol look like on interactive brokers through a Sierra? And how would you approach a study or method to quickly cycle order routing? Cycle order routing. What does that mean? Cycle order routing. What does that mean? For change from smart route to others. Control bar, excellent approach. I'm not really familiar with how IBKR integrates and executes through Sierra. I know that there is an integration. I also know that it's not considered a robust integration. Um, so you're saying like I'm assuming smart could be any security type, but let's just say it's equities, stocks. You're trying to switch from like smart to execute on ARCA. Is that what you mean? Like, you want to submit a buy 100 shares of Apple, let's say. That's really hard to see. Let's change the color. You want to buy 100 shares of Apple on Smart is the default route, but you want to instead buy 100 shares of Apple on ARCA or NASDAQ or EDGX or something, is what you're saying. You want to route it to a different spot. I have no idea if the IB integration to Sierra chart supports order routing switching. Does it? Do you have any idea? Well, let's Google it. I have absolutely no idea. Let me open up a new tab and take a look. Sierra chart IBKR order routing. I'm just Googling this. Let me get this. Let's see here. Sierra chart does not provide support for interactive broker symbols or data issues. What's included? Resolving. Is there a routing? Symbol differences for positions. Interactive brokers has inconsistent and complex symbology specifications. This is a major fault of interactive brokers. There is a problem where it is possible to use smart order routing, but a trade position update will specify the exchange that the symbol was filled on and create an inconsistency. Is there a spot for order submission via ACSIL? Is this interactive order routing, pacing, violation, data issues, missing data to my goodness, there's a lot of problems with TWS stuff. Order. What about the last one? 5 out of 5 is route data. I honestly have no idea, Ziggy. Oh, there's an example. Oh my gosh, that's a symbol name? Okay, for those on YouTube who don't see this, this is what he wrote as that's a symbol name. SPY, I'm assuming option of a September 28th expiry of 2023, 434 puts on Smart. What does the 100 mean? Do we know what the 100 stands for? Like, I'm assuming, so this is the underlying. This is the type, in other words, options, not the underlying equity. This is expiry. This is the strike. This is the option type, whether it's a put or a call. This is the route. I have no idea what that is, and that's obviously currency. This is probably what Sierra chart was referring to in the documentation when they said that their symbology is complex and difficult. Or was that symbology? IB symbology is very complicated, and there's no set text string for a symbol that can be looked up universally within TWS or Sierra chart. That's a major design flaw. Yeah, you might be... No, J-Glass, it's not 100 shares because it's options. It's not, and that wouldn't be in the, or you're saying it implies 100 shares of the underlying, that one contract of this September 28th put, 434 puts, is 100 shares of the underlying. You might be right, actually. Yeah, you might be right. That makes the most sense. Ultimately, though, it looks like this is a very, very not robust integration in the sense that I'm not sure how reliable it will be executing through to IB. It is just snowing like crazy outside right now. I don't know if you guys missed this is at the beginning of the call. This is what it looked like outside my office, and it is just dumping out here right now. So yeah, Can you, Ziggy, look up, you know, the smart find symbol thing? Can you look up other non-smart routed, um, non-smart routed symbol? Like, can you look this up coming through a different exchange through the symbol finder? Yeah, I just don't know. I didn't even, first of all, I didn't even think you could trade options through Sierra Chart. So that's new to me. Anyways, yeah, I don't know, Ziggy. I really don't know. Sorry, man. No, it's not pretty. Correct. It is not pretty. Sovereign's got a question. Let's go ahead and copy that over here. Ahmed. Oh, thank you. Thank you, Ahmed. Okay, I'm going to put this in here. For folks who are watching this on YouTube later, Ahmed kindly posted a video from Varillo Trading, who's got a lot of interactive brokers and Sierra Chart related content and even ACSIL programming stuff. So go check that out if you haven't already. But here's a video on how to use direct routing. So thank you for that. I think this is exactly what Ziggy's looking for. So cool beans on that. Sovereign says, I have an indicator idea. I'm at work, so I can't talk, but it was a buyer-seller power indicator. It would analyze the strength of each buy or sell order in relation to how much price movement it causes. So strength of each buyer-seller order in relation to how much price movement it causes. For example, you can see a positive deltas all day long, but price seems to react and move a lot for relatively low number of sellers coming in. That would indicate that the seller has more power or that each sell order is worth more. I think this is very close to the delta, except that you want the price component in it. You know, this is actually what a lot of the those lagging indicators show. Maybe the calculation is a little bit different, but things like relative strength and things like that. Although I don't have in my mind how those are exactly calculated, so maybe I'm wrong. Maybe that's not how they are. We have to look up the exact definition of how RSI is calculated. But essentially, you're saying if you see a lot of buy orders go off, a price doesn't move, but a lot of volume happened with buy orders, market orders, which interacted with sitting on the book limit order sell orders. The price did not move. What you'll see is a delta that, let me see if I can find some on my chart. That's not a chart. Let's look, oh gosh, I don't know. Let's look. This is AMD. Echo. I'm looking for something on the footprint that will kind of match what you're saying. Let's maybe on a different symbol. Let's try Tesla. So I don't know, maybe up here on this bar, let's say this 468 in red wasn't right here, but it was on, let's say it was blue on the ask here, at the very top here. So let's say it came up here and then 468,000 shares were executed on the ask. That means somebody bought from a seller who was sitting on the book 468,000 shares up here, and we did not move at all. Just like this means someone hit the bid for 468,000 shares here, and yet we're still up here. So that type of information is that's probably recreating the wheel a little bit, Sovereign. I think there's probably already established indicators out there doing very, very similar to that. Okay, I guess free-for-all session now. Last questions before we pack it up here. What do we got? Got a few folks typing. While we wait for that. This is such a this is so important. Folks who ask, you know, I'm new to trading, or I'm new to coding, or I wanna build some kind of automated trading system, or I want to learn how to trade. This is, first of all, go watch the Edge video on my channel if you have not already. Not because any other reason other than that it might end up saving you from losing money, in the sense that it kind of explains how my journey went and how I got to a place where I was able to finally define what Edge actually is, how it's developed, and how to get to a place where you can find that. Like, how do you, okay, so you have, let's say you had an indicator and you wanted to buy when the indicator's low and you wanted to sell when the indicator's high, and then you tried that and you're like, hey, this doesn't actually work in real life. You know, the YouTube video saying make $5 million quick in 5 minutes. They lied to me. They weren't telling the truth. I can actually make 5 million in 5 minutes using this buy sell MACD indicator. And then you start looking for other explanations as to how to actually make this work.
Hi.
Hey,
Hi.
Ahmed, how are you?
I'm fine.
It's late.
Can
It's
can
late
you
over
open
there,
please?
isn't it?
What?
It's late at night over there, isn't it?
Night, yes.
Hmm. What's up?
Can we look about the volume? We talk about it last week.
Remind me again. I do not remember what the conversation was.
We talk about volume in intraday volume leakage or some, yeah,
Intra
error.
Intraday volume leakage. Oh, do you mean the one where you posted the screenshot and the intraday volume wasn't matching the daily volume from the feed?
Yes, yes.
Yeah. Okay. I remember that.
Can you open any chart now? Can you open any chart
Can you
for any
paste? Can you paste the screenshot here so I can paste it up? Can you paste it in coding stream?
I'm I'm talking with you from my phone, so
Oh.
I'm not.
Okay. Hold on a second. Let me go into our private chat and find it. 1 second, everybody. Ahmed, where are you? There you are. No, that's not it. It wasn't from the private chat. We must have done it somewhere else. Okay, I'll just draw it out. What I think.
Can you open any chart? Can you open any chart? Intraday chart. Now in Sierra.
Oh, in Sierra.
Yeah.
Tesla intraday daily volume, 56 million. Yeah. Okay.
Okay. Add a study. Add a new study.
Okay, let me save this first, and then let's go to study. I'll F6 this. Okay.
Cumulative sum of study.
Cumulative
Yeah.
sum of study. Okay.
Make it for the volume.
Make it
Main graph.
for volume subgraph 1. Do you want to restart at start of trading day set to yes or no?
Yes.
Yes. Okay. And then put that on. Okay, it's this bottom indicator down here. Okay.
Now, you see this sum? This is the intraday volume. There is a difference here.
Yes, there is.
You see?
Yeah, I definitely see it because this says 62 million.
Mm.
And this says 45. What does this say? 45 million. That is very odd. Yeah, I don't. That's very weird.
Now you understand me?
Yeah, yeah, I do. That is very weird. ID1. Again, and it's even referencing the same study here, so I don't even know. What does that study do? Like, what is this? Where is set defaults help description? Cumulative sum study adds together the values of the selected study subgraph within a study at each chart column from the beginning of the chart to the start of the trading day. If you have reset at start of trading day set to no, it'll just continue going. It will be the start time or even if the evening session time. So I wonder if this number 45 will change as we adjust the session times on that chart. So if I go to chart settings, session times, and then I change this from being 8 a.m., let me just update this to 9 a.m. and let's look at this number sum, which is currently at 40, starting with 45. I'll hit apply all. It was at 45. I have a lot of data loaded on this particular chart. Maybe this wasn't the best one. I should have done this one over here.
You can make it.
Oh, now it went down to 44. Look at that. It went down to 44. It was at 45. Yeah. Now it went down to 44. So if I put it at 4 a.m. when the pre-market opens, what do we get? We get 46. So it's not accurate regardless. No, I see what you're saying. I have no idea what I just wouldn't use this cumulative sum of study. Because this is closer, right? Like if I open Lightspeed, let me just open Tesla.
If you make any custom study to calculate the daily volume, it will be like this.
It's wrong here too.
Yeah.
Oh, well, at least it's consistently wrong everywhere. Good. That's what we like, as we're trading and depending a lot on data, is for the data to just be different every place we look. That makes things nice and easy. No, this is, Lightspeed says 57 mil, this says, Sierra says 67 million. What is my daily? Oh, interesting. My daily chart in Sierra, which is on a different screen, says 57 million. So my daily chart matches Lightspeed much closer. Huh. That's interesting. Okay. I mean, Ahmed, can you use something, can you write your own version of cumulative sum of study? Like, I feel like by now I think you have. Oh, you wrote it, and is it more accurate?
Yeah, the two numbers aren't matches.
They do match.
No.
Oh, they don't match. So even your own version doesn't match. Does your version match the sum study numbers?
Yeah.
Oh, so it's almost like these are being derived. This volume is being derived from somewhere else. That's interesting. I don't know. Does anybody else on the line who's watching have any experience with that? I'm not sure. I might have to ask about that. That's new to me. I don't know. Ahmed, I have no idea. That will definitely make it tricky to have consistent volume based. But okay, so if anybody knows what's going on with that, reply If you're live in the Discord, reply in the coding stream chat. If you're not live on the Discord and you're watching this later on YouTube, reply in the YouTube chat if you know why this is happening, and we can get that information over to Ahmed, or if you know any other ways to get around that, because that is definitely not consistent or accurate to each other. Sorry, mate. Okay. Sovereign follow-up. Okay. I think we're gonna call it there. Been going for an hour here, a little bit more, hour and 15 minutes. Any other questions? Oh, this is what I was going off on. This thing. So many folks have not internalized this. If you have nothing to lean on, if you have not figured out a way that you can explain to somebody, if you can't explain to me in 2 sentences, 3 sentences, how you're tilting the table, like if I ask you, hey, what's your edge? How are you tilting the table in your favor? And you cannot explain to me in 2 or 3 sentences, layman's terms, if you will, surface level, how you are waiting to find the spot where the table is actually tilted in your favor and you have the edge and there's multiple points of edge, then you're just kind of randomly putting buy and sell signals in, or orders in. Uh, that's the cold hard truth. Um, yeah. The question is how do you develop edge? How do you build this out? How do you refine it? That's probably a conversation for an entirely different episode, or an entirely different stream. But that's what it's about, and that's where I'd say go watch that edge video that I made, because it talks about how to build and develop your edge. It really comes down to knowing yourself, and I know half of the people watching will be like, oh, here he goes about the uh, stuff regarding, personality and feelings and all that stuff, but if you are a type of person who doesn't know yourself and you have a way of ignoring risk, you're going to blow up your account if you don't take that, if you don't have a way to mitigate that, if you don't take that under control. So, can you make a GDI tutorial? Actually, what we need to do, Ahmed, is what we need to do is get the new OpenGL features running, because Sierra has documentation. What is new? Search OpenGL. As of December, I thought it was December, but apparently it's September. They've implemented a bunch of drawing functions in OpenGL, and I have not had time. It's just been crazy. I have not had time to go and investigate this. So the drawing functionality in OpenGL has been released. I know Luda has been playing with it, and he's built some pretty cool things. So Luda's got more experience in doing that. But this is something I would like to go through, because harnessing the power of your graphics card to offload all of the rendering from your CPU onto the graphics card. For those of you who are doing heavy studies with, like, let's say, long-term volume profiles or tick-based data, that you're just loading a ton of data and you have a lot of drawing to do on your CPU, and being able to offload that to your graphics card is a huge win. So the performance-wise. So we need to figure out how to get drawings to work with OpenGL. And in an ideal world, a way to draw agnostic to whether OpenGL is enabled or disabled on Sierra Chart. I would like to get a way where if I want to draw a line, I can draw a line, and it doesn't matter if it's going to be in GDI, OpenGL, or something else. So yeah, Cal's reporting OpenGL performance improvement. Depending on how you're using Sierra, it can be massive. For what I do, it doesn't change anything performance wise because I'm not loading years worth of tick data into a single chart. So it just I don't see it. My Sierra is very, very quick, and I don't have OpenGL enabled. I use GDI, and it's all quick. But I know a lot of folks who are doing long-term volume analysis are struggling um, on loading charts with 800 days of tick data. So what is that? 2.5 years? It's almost 3 years worth of tick data on an instrument like ES, which is fairly high volume. That's a lot of ticks. That's a lot of stuff to draw. So yeah, offloading that load onto your graphics card, which is designed to handle that kind of load instead of the CPU, makes a lot of sense and can provide some good performance boosts. Okay, any other questions before we call it? This is so important. If you're not profitable, if you're not consistent, if you aren't confident that you will go in and make money tomorrow, what is your edge? What's your edge? What are you leaning against? How have you tilted the table in your favor? What kind of person are you? What's your risk profile? What are your weaknesses in your personality that will always come out in your trading? Some people can't accept a loss, so they won't put a hard stop in place, and they'll just keep bleeding off until their account. The spot right here, you see the spot? That's your account is blown up. To refer to the thing we were talking about earlier at the top of the session. Standard deviation 1 of the price, standard deviation 2, standard deviation 3, and that's your account blown up because you did not have the risk management in place to stop buying or holding on to this. You didn't have a place where you puked. I know this will fall on deaf ears, but this is the most important thing in trading, in my opinion, is figuring this out. Nothing else. This right here, the most important thing. Anyways, last call for questions. I got a few folks typing, and then we'll call it. No? No more questions? Okay. With that said, let's take a look outside. It is an absolute, oh my goodness. There's just a huge snowstorm that's coming through right now, and it's just blizzarding outside, and there's all the trees are weighed down with snow, and it's really quite beautiful out there right now. So it's minus 38 Celsius where you are. Where are you? It is not that cold here. It's warm because it's snowing. Yeah, but where? Where in Canada? That's quite chilly. I don't even know where that is. Kamloops? Where is that? Oh, okay. So you're way out west. Is it northern BC? Northern BC? Okay. Southern BC, and it's still negative 38. My goodness. Well, good luck with that. And anyone else who's getting hit by the snow, good luck. Get those snow tires on. Drive safe. Everybody have a good weekend. And we're out. End stream.